Good evening, everyone. Welcome to the 2025 EPRA Insight Nordics. I'm delighted to introduce the event on behalf of EPRA and then hand over to the host of tonight's panel, Paul May, Director, Head of Real Estate Equity Research at Barclays. You'll know there's an esteemed panel of CEOs from across the Nordic real estate sector waiting for your questions. So where are we and what do we know? Well, I know that my glass is half full. The surprises and disappointments from last year's geopolitical events undoubtedly slowed progress in many economies and influenced markets globally. The continued macro pressures of the year's opening paint a relatively grey picture. However, looking broadly at real estate in Europe, although there may be a continued risk around the macro, would suggest that the risk-reward looks compelling. If we look at where we are from the beginning of the rate rising cycle, there is refinancing capacity. We are witnessing solid property fundamentals. And importantly, there are operationally strong businesses in the sector. Of the 26 billion euros that was raised in the European listed real estate capital over last year, of which 80% was in bonds and 20% was in equity, it's important to note that the Nordic companies raised 40% of all debt and 20% of all equity, roughly 8.2 billion and 1.1 billion euros, respectively. The importance of Nordic listed real estate in Europe is further exemplified by Swedish listed real estate being the third largest country within the developed Europe index by free float market cap at around 16%. At EPRA, our priority is clear. It's to drive capital into the European listed real estate sector by attracting a broader and a more diverse range of investors, generalists, wealth management, family offices, and retail investors alike alongside fixed income. We published an equity fund managers survey in October 24 that highlighted that over 80% of those managers are bullish towards the listed real estate sector. We encourage you to think big and think ambitiously about the future, notwithstanding the difficult market conditions that might persist across the year. We wish to grow the European listed real estate sector in comparison to other geographical regions, and it's really important for investability. What better opportunity of highlighting all that the Nordic real estate sector has to offer than holding the EPRA annual conference in Stockholm this year on September the 18th, 16th to the 18th. I hope to see you all there. We usually see over 300 attendees at the annual conference in other cities, and we'd expect no different this year. I'll now leave the floor to Paul May, who will host the discussion and close this year's Nordic Insight. Paul, many thanks in advance, and the floor is now yours.
Thanks, Matt, and thanks to EPRA for hosting this as well and giving us this opportunity. I think just concurring from what you've said, we're broadly positive on the outlook from here. I think we slightly differ to some of our peers that it's not just a rate NAV will grow approach, which to be honest, I think is slightly meaningless. It's more around the operational performance of listed companies. We think they're in a stronger position than a lot of private owners of real estate, but also all the macro concerns and things you mentioned ultimately are a bigger risk for a lot of more indebted private investors. And we think the listed companies actually are in a stronger position to take advantage of that. So we're encouraged for the year ahead. It's obviously started with a bit of a wobble, but hopefully we can move forwards from here. Our conference last week was very well attended. I'd say the mood was slightly more somber, but probably driven by the performance of shares into the conference as opposed to necessarily the outlook that people have. Just so starting on that, I think we've probably got a couple of tracks that we can discuss around the operating outlook, valuation outlook, and then opportunities for expansion. Within the Nordic markets, as we all know, on the commercial side in particular, there's been a strong benefit from the high inflationary environment that's been pushed through into rental growth within passing rents. However, market rents on various metrics have been largely static. And so what I'd like to discuss is, how do you see the rent and revenue progression from here, particularly given inflation has been slowing and the economic outlook still remains relatively sluggish? So maybe starting with you, Ulrika, to sort of kick off around how you're seeing it, how Wihlborgs is seeing that in your markets, and how you plan to address that growth potential moving forwards.
Yeah, so overall, I would say that if you have the right quality and you have the right location, passing through the last couple of years high indexation and also a bit of a positive increasement in rents ahead is likely. I think that there's a lot of changes going on. Our customers need change of different kind of things. But the most important trends is that you're willing to pay for quality and location. And you're really focused on how you can, what do you need to do to actually provide your employees with the best facilities, and also surroundings and the other things. How do you create the culture in the company and such? So, and also, of course, let's remember that the area where we work, we have not the top rents in Sweden. We have a good growth in the region, and the rents has been growing slightly accordance to building costs. So there's some substance also between the increase in rents, historical, but also today. If you have more of a, if you are in an area with high vacancy, poorer quality, then things are different. Then you will have more of a struggle and need to spend more to change that, I think. But otherwise, we still see possibilities. It's hard work and it's not easy, but definitely there is still positive things to do.
I think that last point is quite important around it's not easy anymore. I think we had 13 years of real estate was easy, and now we're going to have a period of time, and I suspect the whole of the next cycle is going to be a more operationally led, more difficult cycle, more traditional real estate cycle requiring good operational performance. And Joachim, to you as well on the mention around the different rent areas. Obviously, you have a spread across not just Sweden, but across the Nordic markets. Are you seeing differences in different submarkets? You know, is Stockholm more challenging potentially than say Gothenburg or the Öresund region? How are you finding that in your negotiations and discussions with tenants?
Yes, certainly there are differences between Helsinki, where Finland paints perhaps a slightly more gloomy picture than the rest of the Nordics. But Oslo is super strong. The Norwegian market has been performing well, very well over the last couple of years, not only driven actually by energy, but also through a diverse economy and a thriving company scene, particularly in Oslo, of course. And then you have Copenhagen, which Ulrika and I share, I think, a positive view on. Denmark has performed very well over the last decades with a high GDP development, etc., etc. And then, of course, we have Sweden, which is Castellum's main market, but there you see differences between the sort of mid-sized Nordic cities such as Uppsala, Västerås, Örebro, etc., where you have a very stable business and public sort of affairs or activities, where rents are relatively low, to be honest, in those regional cities. But the building costs and the like are similar to those in Gothenburg or in Stockholm, meaning that the pressure from new construction, at least from the office side is relatively low. So there is a clear divide between the pure metropolitan areas such as perhaps Stockholm, Gothenburg, Copenhagen in Sweden, and the more regional cities. But to be honest, the regional cities represent for Castellum at the moment the strongest sections. And even though we don't have the highest rent levels, it's a super stable business. And coming back to you, Paul, what you mentioned, whether it's easy and whether you go back to a more traditional real estate business, that is a traditional real estate business section of our geography. You have never been able to do quick fixes and erect a fancy building and get top rent levels in Örebro. That has never been the case. So it's always been hard work. It will continue to be hard work there.
Yeah, and I think it sets the listed companies apart, I think, from that cap rate driven capital structure or spreadsheet investor to that, as you say, knowing how to operate real assets and how to operate and get the best rent levels out of those. And moving to Jörgen as well on a similar question, appreciate slightly different or very different subclass and subsector on the warehouse side. Obviously, there's been a lot of press and commentary around oversupply in various markets and that having a knock-on effect onto rent progression after a number of years of exceptional rental growth and strong operating performance. How are you navigating that? How's Kittiana navigating that? And how do you see that moving forwards? And are you the exception to the rule, should we say?
I wouldn't say that, of course, we are monitoring the oversupply very closely, but it's a regional challenge around Stockholm, Mälardalen, and also a bit in Jönköping. We haven't seen any impact yet in our business. We have very high letting ratio, but with that said, you never know what will happen in the future. I think it's not likely that a lot of customers that have their stable business in, for example, Helsingborg, all of a sudden moves to Jönköping because there is 80,000 square meters vacant, newly built. It can happen, but likely not, I would say. But of course, in theory, the dynamics between supply and demand makes something, and it's not that easy to negotiate with customers and ask for higher rent. I think it's more likely that we follow the indexation now. And with our strategy with the long-term owning of the assets, the long-term relationship with the customers, you had 6.5 this year in indexation, you had 10.9 the other year. And then it is for, let's say, 10 or 20% add-on in a renegotiation. That's very tough. That's not doable in this environment where also a lot of players now are suffering a bit because of the slowdown in the economy in Sweden, where the private households paid much more in interest rates. They had also the inflation to buy food and beverage much more expensive, and the salaries are not that high. So we need that the consumption has to start again, actually. And with that said, when it will happen, if it's in Q2 this year or it takes all the year, it's tough to say, because people also tend to have some more money into the buffer again, to save some money before they start to consume again. But once they start to consume, our customers will for sure perform better, and then they will ask us for more services. But all in all, our operations is very stable at the moment. We have never had better performance, so to speak, but we also sense that, as you said before, it has been some exceptional years through the pandemic. Now it's more of a normalized situation for us.
Just bringing that all together, Soren, from your perspective as a sort of capital allocator, how are you looking at things? Are you focusing much more on that differential of operational performance and outlook on the underlying for each of the companies? Given, as I say, for many years it was generally speaking by the highest levered company or one of the highest levered companies and drive the cash flows. Again, from our side, it was simple, and now it becomes more difficult. How are you looking at that sort of capital allocation across the different industries, subsectors, geographies? How do you consider that or factor that into your thought process?
Yeah, well, thanks, Paul. So Real Advisor is based in Copenhagen and as an investor, and we have been only investing in listed European real estate. So I appreciate and I subscribe to your thesis that operations will be more important and that perhaps the private investors, they have more difficulty with deleveraging than the listed sector. And our competitors as asset allocators are sometimes people on spreadsheets leveraging. And from that perspective, we are looking forward to the listed sector and to our clients having more benefit from the competitiveness of operations versus leverage. So I subscribe to that fully, and I think that's right. I think also another point on this pricing, I think what people don't appreciate is that the listed real estate space, with some of these companies here as well, they actually hold pricing power compared to just normal real estate investments. So a lot of especially I think in Sweden, there are some very good companies who dominate market segments and are able to have long-term relationships and can actually create supply that other people cannot create. And they can also set prices as opposed to if you buy an office building on the outskirts of a big city in London or Chicago or somewhere. So these guys, they have a pricing power, which I think as a long-term investor, they can use to create shareholder value on the long term for investors. And this is specific, I think, to the listed real estate sector. There are, of course, asset managers around the world who do a good job. But for the Nordics, this is a particular case because nowhere else in the world, I think, I haven't heard of any other place where you have so much of the commercial real estate of a country in a region listed. So actually there's a huge pricing power represented in the Swedish listed real estate sector that you don't see elsewhere. And that's why I think that is interesting. And that is why we have, in fact, now that the leveraging risk has gone, doubled our exposure to Sweden, even though we are still a bit underweight to the EPRA index.
That's good to hear. It's good to hear. And staying with you, Søren, on that leveraging, spreadsheet investor versus operational performer and strong underlying operations. And we hear that, we concur that when we talk with some of the, say, private equity investors, it wasn't about operational delivery. It was just about lots of low-cost debt was kind of the investment strategy, which we think has broken. How do you view the evolution of, say, swap rates or base rates? I think expectations of further declines in the swap rate. Appreciate there's some further declines in base rates, but they've been pared back. How do you see those factoring into your thought process? Is it simply a base rates down, real estate good, or are you looking at it more base rates are stabilizing or swap rates are stabilizing, financing costs stabilizing? So that's not going to be the differentiating factor, or do you still think that is going to be the differentiator moving forwards?
Well, I think that the main thing is not necessarily whether you are 50 basis points higher or lower. You can do perfectly operational real estate business at different levels of interest rates. The key thing is that you have to be able to plan. You have to be able to plan more than just one project at a certain swap rate. You have to be able to, as an investor in listed real estate, to look more into, okay, so maybe the 10-year Euro swap will be between 2.25 and 2.75. Yeah, I think if you are in a corridor like that, a lot of investment processes are much easier because you know what you have to deal with. But if you are directionally moving from 0 to 5 and from 5 to 3 to 4, and then people will stay on the sideline for a long time. And that's what we've been going through. And I think even though you can look at the 10-year swap rates that have been relatively stable, they have been about 3, now they're about 2.5, but still people are not yet quite confident, in my view, that they're stable enough. But they are, and that's why we have increased transaction markets as well, because partly because of the more stable swap rates, but also, of course, credit spreads have come in dramatically. And I think that the second part of that cycle, you have the credit spreads coming in last year, and this year they should be benefiting also the real estate companies, which is a way a credit spread as well.
I think that last bit's quite important, because that probably gives a further benefit in this current cycle to listed companies. Yeah, there was a period of time where those credit spreads or those borrowing cost or borrowing margins actually became tighter for some private investors because the banks were sort of scrambling away. And now I think the listed companies have that security, that quality bias, and that's what we're hearing in various markets, that actually there's a funding advantage as well for listed companies, which is also encouraging. Moving back to you, Ulrika, on a similar question, how are you planning the business moving forwards? Is it, is there just a hope for further lower rates, or is it an acceptance that rates will be higher than they were, and actually that you could potentially take advantage of opportunities that come through, probably more so for all the reasons that sort of Sora mentioned around that stability of rates, better credit margins moving forward? How are you thinking about that, or how's Wihlborgs thinking about that? And I suppose the final question, is how do you view the capital structure of the business in this environment versus where we were with a ultra low interest rate environment? How are you thinking about that?
Let's start with hope. Hope is of course interesting, but it's hard to build a business on hope. It's better to use preparedness for different kind of environments and be ready for different things. And first of all, I'd like to just comment a bit on one thing you said, Søren, about being really large in one market and taking advantage from that not only in how you can be seen as an investment, but also how we can benefit from being large in one market. I think we have been really strong in that and have been able to, one part of why we have been able to continue in a quite good way also during these hard times is that we are really focused on our clusters and being really strong at our markets. We can take advantage from that because we are so close to our business. And so you can take care of risk management in different ways. You can spread your investments, or you can really focus, and that could be taking care of your risk in different ways. And we have chosen being really focused on the market where we are and being really large there, so we can meet our different clients' different needs. So how do we prepare us ahead? We will continue with the cash flow focus. That has also brought strength to us during these times, and that is definitely our 100% focus ahead. That has mean that we have been able also to do investments during this time, and we will continue with that. When things turn, I don't think it will turn very quickly, but when the turn comes, we are prepared. We have already started and continue with investments during this time, and I think that's, of course, different companies have different possibilities in this, but we have had this possibility, so we have been able to do that. And we aim for continue doing the same thing. And that includes the transaction market, where we have been quite picky and will continue to be picky, trying to find the right things for us. It means that there could be things out there which is really interesting, but if it doesn't really fit into our structure or what we can add on value to, then it's might not be the right thing for us. I'm sure that the reason why we also have been able to look into many different things the last years as well is also because we have been able to we have felt also during this time that the financing situation is okay. We have been able to we have our connections to the bank systems and good relations there, and yeah, the possibilities has been there. So the things we have wanted to do, we have been able to do that. And I think overall it's important that you take your decision on what suits you best to do. There was also a time where we were seen as a quite boring company, maybe stable and boring, because everybody else was so wild, and why wasn't, and we choose not to be wild in that way, because we thought that stability was really cool. Different times shows different things, but you have to take your decision on what you think is most right for you to do. Was it some kind of answer to your question, Paul?
Yeah, yes, it was.
Yeah.
I think I suppose the final bit is, and I concur that we've seen what's happened to some of the wild companies over the last couple of years, and I think there's some private vehicles out there that would also be considered wild in the way they approach things, which creates opportunity. I suppose the one question, if we could get a number, if possible, from you around, if 50% LTV or was considered okay in the past. It was 60 pre the GFC, then became 50, 40 to 50. Is 30 the right number in a more operating led? Because you've got arguably increased operational risk, and therefore that in theory should concur with or be linked to reduced financial risk or financial leverage. So just wondered how you think about that in the current cycle. And I'll come to Joachim and Jorgen on a similar question as well.
I think that for us, LTV around 50% is totally okay. We could go a bit lower, and we could be also a bit higher if we could manage that for a period of time. But overall, I think around 50% is okay for us. Preferable maybe a bit below, but around that is okay. And that is also a reflection of the valuation in our region. In our region, and with the kind of portfolio we have not been stretched, nor during these times where we could see that happen in other markets. The transaction support wasn't there for going to the highest levels. So, I mean, you have to take several things into consideration when you look at the LTV numbers. What the fluctuation during different times could be, and also, of course, most of all, could we cope with the cash flow we have to cope during different environments and pay higher caps as well. And the finance structure we have been able to cope during this time, and we could cope also during even harder times So we take that into the perspective.
I'm sorry, very last one while I think about it. I will come on to Joachim as well. How important do you think, because it's something we're seeing increasingly from certainly marginal investors in terms of questioning net debt to EBITDA levels? So LTV, as you say, is a function of the V, and arguably the V is to some extent what people just decide it is. It's a relatively made up number. And so how does that net debt, because at roughly, I think 10 times roughly, which is where I think Philbox is at the moment, that for pretty much all marginal international investors would be considered far too high. Is that something that you consider being more of a focus point than LTV, and almost LTV is backed out from that, or is that not as much a consideration?
I think that when you compare debt to earnings, that is real figures.
Yes.
And there's less of a speculation in that, and valuation is always tricky, and it's evaluation, and when you combine different kind of non-certain figures, the answer is also non-certain. So, but and everybody knows that, but sometimes we tend to see a figure and think that that's the truth. So the last years have obviously put some point to that, and that's reasonable.
Thank you. I think Joachim, I appreciate there's a number of questions in that around the financing side and the various thought process, but how are you seeing things from a Castellum perspective? Obviously, you inherited a balance sheet that arguably was potentially more stretched than you would have liked it to be, given the previous management decision making. But how have you approached that and thinking about that moving forwards?
Well, for us, I mean, with total assets of 155 billion SEK, it's important for us to be able to source our finances from whatever source that is best price at the moment, and that means that we have currently a 50-50% divide between bank and the bond market, and we'd like it to keep it around those levels, and that means that we have to adhere to the demands of the debt investors, and they are typically now getting used to what some kind of Nordic levels, which they frown upon, but then they still buy our bonds. So in under those circumstances, we believe that the below 40% LTV, which I agree is slightly a questionable figure, because the V is always can be questioned. But we have operate with a maximum or minimum ICR of 3 times. So that's real figures. And we'd like to sort of add the risk element that will give us the return from our projects, from us being able to perhaps withstand a higher vacancy rate sometime until we get the right tenant or the right rent levels into our buildings, and perhaps work less with the higher financial risk. An element in that is that we'd like to extend or prolong our debt maturity profile considerably compared to what it was maybe 3 years ago, when you know, short money was so cheap that you were plain stupid if you didn't take it. We believe that the duration or the maturity profile of our both the bank debt and the bond market debt is something that is very critical looking forward, and not exposing ourselves to the risk of these sort of turbulent times that the entire real estate market went through after the Russian aggression towards Ukraine. One comment though on transaction opportunities. I mean, there's a slightly misunderstanding in the international market that every time the interest rates go up, there will be blood on the streets of Stockholm, and people will jump from whatever high building they can see because everything is going down the drain. That is very seldom the case. I think I'm one of the oldest on this panel. I've seen at least 3 crashes. There's very seldom blood on the streets in Swedish cities. So there are of course opportunities. We've been very picky. We've had some hit and miss in the last couple of months in terms of transactions, because we would like to make sure that the things that we buy fit into our profile, our geography, and the kind of assets that we would like to have. But we are not by any means stressed or under pressure to create growth by acquisitions. There are acquisitions, but they are not that priced as some international investors sometimes seem to believe. So good assets are priced in a relatively normal way and have been throughout this period.
Yeah, I think I suppose the one thing we would say is there was to Ulrika's point, a hope over the last couple of years that we're going to return to ultra low rates, and don't worry, as long as you hold on, you'll be okay. I think it's quite telling that the peak CMBS defaults in the US was in 2012, not 2009, when the GFC sort of happened. By 2012, arguably rates were ultra low and everything was fine, but then we saw the peak level of defaults. And who knows? 2025 is 3 years after rates started increasing, so maybe we might start to see some opportunities. I think there's also the element of there was a mantra of survive to 25. Again, that was driven by survive till ultra low rates come in. They're not coming, and maybe that will create more opportunities, not necessarily distress, but motivated sellers is kind of how we perceive it, and we think that listed companies are in a good place to take advantage. Jörgen, asking the question in a slightly different way to you, because you've been a strong user of equity and equity issuance to fund acquisitions over the last 12, 18 months. You've been very well supported by shareholders. I think there's been a view that is the right strategy. Do you see that still being an opportunity moving forward? I appreciate share prices have moved, but it's not as though you're trading at 10% earnings yield or something like that, so you've still got a relatively attractive cost of capital. Or do you see a pause now, given that recent movement in the share price? Or are the opportunities just so good that you can fund those with equity continuing moving forward?
Well, I have to start with a lawyer, so it depends. So for sure, we have tapped the equity market a couple of times the last 12 months, and we have invested like 11 billion SEK. So it has been a fantastic 2024 for us, and very strong support, as you say. If there appears a good opportunity, are there assets that will fit in our portfolio at the best locations with the strong customers, etc., and the deal is accretive for all shareholders, I think it's a no-brainer for us. But we also used to say to the market, we are not financially limited. We can work with both equity and also talking to the banks. So it could be a combination. We have been quite early on to take down the risk in the company a couple of years ago. So our LTV has been hovering around 35 to 40%. Last last public report was 37.8, and also a fairly low net debt to EBITDA. So I think we are a low risk player, so to speak. And yeah, looking into various opportunities out there, and if there is a good timing and we see the deal is accretive, we can go for more equity fueled transactions for sure.
I think that's an important bit, the timing side. I talk to a lot of private investors, and they're envious of the listed company's ability to raise capital, equity capital, very quickly, particularly for core assets. Speaking to a lot of private investors, it could take 6 months to a year to ring around investors to get the level of capital you raised overnight. I think that's a huge advantageous position for the listed companies. And do you, Søren, from how you look at things, are you more supportive of a lowered levered company base, a balance sheet versus more equity funding? How do you view the outlook? Are you supportive for the right opportunities on equity funding, to use Jørgen's commentary, or would you like to see leverage jacked up again, an increase in the current environment?
Yeah. Obviously, I think that it can be too much leverage, which is one of the main reasons we haven't held so much Swedish a few years ago. But also, I think if we think about listed versus unlisted, the different local markets, they have different customs, and if you deviate very much from what everybody else does, then your product turns out to be very, very different. So meaning that if there's a listed fund and an unlisted fund, and the unlisted fund has a leverage of 2 times and the listed one has 1 time debt, then if you say 1 time is too much and you want to bring it further down to a third in terms of thinking LTVs, then maybe a lot of investors will think you are being too conservative in that market, because they will then invest the money in the unlisted fund. If you can have secured financing at good rates and everything, why would you go and not use it? So I think it's not a one-way thing. But I agree that the LTV is a lazy number. It's basically just been the simplest number you can make, and therefore we've seen some shortcomings in that. But yeah, the net debt to EBITDA is a more robust number, but it's also a lazy number. Because the key thing is, to me, that each company's management, they should be secure that they are always the ones making decisions. It should not be the bank, and it should not be the bond market. That is what it's all about, to me. And that can be different depending on what kind of assets they hold, what kind of segment they are in, and what kind of mix of finance they have. As long as they are fully, and they can say to me, we are in control of our decision making, it's not the banks and it's not the bond market, then I'm actually happy. No matter whether the net debt to EBITDA is 10 or 12 or 8, that's not that important. It's the other thing that's important. They can explain why they've chosen what they've done and still are in control.
Yeah, I think on that last point, I think it's been shown that a lot of companies weren't in control, even those that were seen to have okay financing structures. If you look at the equity market, and I'm not saying the US market gets everything right, but I think they've done listed real estate relatively well in the US, and that tends to move to a lowered levered business model. And the reason we look at it that way is, at the end of the day, listed real estate is a permanent equity vehicle. It's a permanent life vehicle. Therefore, it will have to ride the gyrations of the various economic cycles, potentially more so than private vehicles that are a little bit less, maybe for a shorter lifetime or so on. So as a result, we think that financial risk has generally not been as positive in the good times as it is negative in the bad times. and that sort of skews you more towards a more manageable leverage position, not a 2 times net debt EBITDA type of level. We are a capital intensive industry, but certainly maybe lower than we've had in the past, and particularly at the moment when or in this cycle that we see with that operational risk or operational leverage that is higher, we think that then you've got to manage that risk profile somewhere else is how we view it. But ultimately, it's all about how can you drive the cash flows? Can you drive that cash flow growth moving forwards? And that's going to, I think, be the differentiator amongst companies within the listed space. We mentioned a few times that the V of the LTV is shall we say, a made up, potentially fictional number, difficult to put one's finger on and say exactly it is right. There's been an increasing commentary over the last few quarters that asset values have stabilized, and that's not just within Sweden, that's sort of across the listed European real estate market. I suppose is the challenge that I would put to that is transaction markets still remain subdued. They're slightly better than they were, but they're nowhere near where we were previously to the levels. So we would still argue that they are an illiquid transaction market. So how can there be the confidence that transaction values are right, when there isn't the evidence to support that in the transaction market? And just wondered how you think about that, or is it to some extent that the V is a slightly secondary concern and you're more focused on the cash flows and the operational side? And how do you sort of square those circles? So maybe start with you, Ulrika, as well, and how do Vilborgs think about that?
Yes. No, I agree. And of course, I think that we will see more transactions ahead. And transaction is, of course, a very important part of valuation. And valuation, it's important as well, but you have to use that number for what it is. There are some uncertainties in it. I think that we use it like that, and I really like your comment on that, or it was you, Søren, who mentioned that it's very important that you don't use these figures as your kind of a mark for. So if I'm in this area, then everything is fine. You always have to stretch your own mind, but when you are in a position where you are forced to do things, that is not the best position. So trying to stretch your thoughts on what you think is the right thing to do. Also, when you look into a possible transaction and the finance position you should have, very important for us. And you are a bit dependent on the transaction market, of course, for the attractiveness of the area where you are. So a healthy and good transaction market is a good thing. But also, actually, I say this sometimes, we use the transaction markets as a fundament, as a proof of the value. And sometimes we think that transactions feed a higher value. But I also think of it as the opposite, because every time a property change owner, the value on the paper is maybe higher, but the actual value could be lower because you lose information. You lose information and knowledge about the product, and that is, we rarely discuss that. But interesting thought, I think.
Yeah, and Jürgen, moving to you, obviously you've been active in the transaction market. You've generally been acquiring at relatively attractive yields compared to either your own valuations or say where some people think the market is. At what point does that become the value? to some extent to Ulrik's point, it's probably the opposite, which is the transaction market maybe proving values are lower, but necessarily values are higher, or is that just your ability to unlock very exciting opportunities?
I think it's a combination, but yes, it's been some interesting discussion with the external evaluators after our acquisition. What is actually the market yield? And it's very difficult and challenging for them to put any other numbers than the last transaction. So with that said, we haven't adjusted those acquisitions something. On the other hand, there are a lot of evidence that there are lower market yields, so-called. We have seen other transactions finalized before Christmas, and also based on intelligence in transactions we are participating in as we speak. So yeah, we'll see. We never have been keen to push the values to the limit, so to speak. We are not in a distressed situation. So as I said before, V is a V, and it doesn't matter that much actually. But yes, we feel that the acquisitions we have made, that was very good timing, attractive yields. But also quite funny that I had a discussion with an investor yesterday, and we went through those numbers. And as you said, Paul, the EPRA yield last reported was 5.5, and we acquired at 6. And he was very clear and questioned me. Is that good enough for you to acquire at 6 when you lose 5.5 and based on share price and screen price and so on? So I said, that's not how it works. If it's a good asset and it's good for our customers and our operations, we cannot acquire and trade based on what is happening on daily basis on the screen. But that's two different worlds, I would say.
I think that's a very fair point. You should do what's right for the business, and the share price should, in theory, over time, take care of itself in the right way. And Joachim, as well, to you, and maybe factoring in on my sort of last question, which I'll come back to everyone on as well, that valuation point, but then also, are you seeing more opportunities in the market? And as I say, I'll come to others, and I suppose, are you excited about the prospects over the next 12 months for both Castellum, but also the listed real estate market?
Oh yes, and that's not only because I'm paid to think so. It's also the fact that we've been transacting over the past 2 years since I came on board about 10% of the number of assets that we have. So we've been acquiring and we've been disposing. So I don't fully agree that the transaction market in Sweden has been illiquid. There's some areas where there's been very few transactions. One of those is Stockholm CBD, where office transactions has been very few over those 2 years. However, there are opportunities. We are picky. We are looking very much into whether these assets will contribute to creating shareholder value over time. And that means that acquiring for the purpose of growing your balance sheet or simply buying cash flow is of minor interest to us. However, there are opportunities, but I think that they more lie in the fact that there are some real estate owners, particularly in Sweden, but also, as a matter of fact, in Copenhagen, that are very ill prepared for the future, i.e. the cost of running any business based on increased reporting requirements or sustainability issues, or simply the need for further investments in your assets will just increase, and they will drive probably less professional asset owners out of the business. Not that they become bankrupt, but because it's simply not worth it anymore. And I believe firmly that is an area where we as a professional real estate owner and manager, together with my colleagues on the panel, we will do a better job than quite a few of the closed-end funds or private equity funds that have a different business model that I think will not be so very well tied into the next 5-10 years, which I believe will be materially different from the 5-10 years that we have behind us.
No, I fully concur with that, and that's how we see that acquisition opportunities coming to the fore. And for you, Soren, and then I'll come to Ulrika and Jörgen on that same sort of outlook point. How do you sort of, when you look at a company, is it much more cash flow focused than it is, say, balance sheet valuation focused on a NAV GAV approach? And also, are you excited? Do you see good opportunities for the listed companies over the next 12 months?
Well, I think that from my perspective, it must be difficult for the listed companies because a lot of them are so cheap that it's cheaper to buy the shares than the assets of Structure. But I think you're right, Paul, when you said that values have been difficult to use for a time, but that is also a function of what you said. In a distressed market, then there's not much liquidity, and then there's not much faith in the values. I think if we come into a different market again with more transaction, then the values will pick up in terms of importance again, because they'll be the meter where you can see whether there's an arbitrage or whether there's not an arbitrage going on. And obviously there'll be takeovers coming at some point, and obviously some companies will also perhaps decide to buy stock. So there'll be two things going on, in not in the first half of this 25, but when we come to the end of this year and balance sheets are more repaired and outlook is more certain, more stable financing, hopefully, we never know, but let's just say that's a scenario we are looking at, then 26 could be really interesting. And I think if you look back at the financial crisis, and you said, I think it was you, Paul, said it took 3 years for some of these big failures to come through. I think it's the same on the pricing of listed real estate. It will take 3 years after a crisis like we've had before there's enough confidence that the values are trusted again. And that's when the values become important again. And I think 26 will be the big year of looking at values again, I hope. But until then, yes, what we do in our little company here is that we look actually a lot on net initial yields, just like Joachim, Ulrika, and Jörgen when they do a certain investment. We look at the net initial yields of these companies on the books and on the implied net initial yield. And then we assess the quality of that stock, like the quality of that property. That's the main way of looking at how we invest.
No, I think it's important that implied yield as a proxy for where the real valuation, should we say, is, or where the opportunity might be. The thing I'd say on buybacks, I think in my 15 years of looking at listed real estate, there's never been a successful share buyback by a company.
So you're right.
So hopefully we don't see too many of those. And appreciate very quickly, and apologies, Ulrika and Jörgen, it's going to be a quick 30 seconds before a quick wrap up. How do you see the opportunity over the next 12 months? Are you excited by more opportunities coming and for the listed real estate space? Start maybe with Jörgen, and then we'll move to finish with Ulrika.
Yeah, as I said before, we are looking into various cases here, and hopefully we can keep on growing during 2025. I cannot promise that will be on the same level as 2024, but we'll keep on fighting.
Excellent. Ulrika?
Yes, we are also in positive direction, and there will be opportunities ahead of us, which will count 25 and which will count 26. Don't know, but definitely positive.
Excellent. Well, thank you to Joachim, Ulrika, Jörgen, and Soren for, I think, an interesting debate over the last hour. everyone is available to be contacted. If you'd like to speak to me, then I'm available over the next few weeks as well. We're out marketing, so happy to discuss with anyone anything we've heard today or our conference recently. But I'd just like to say thank you again to Ulrika, Joachim, Jürgen, and Soren, and have a lovely rest of the evening.
Thank you.
Thank you.
Thanks,
Goodbye.
Paul.